rather than being a panel, how about we all have a interactive session? I'll ask the first question, but please feel free to pitch in, even with a response, if you want to add to what our panelists are sharing with us. So I'm Kopal, I'm part of the tech engagement team, and we have Amandeep and Payan. I would let them introduce themselves.
Well, I'm Amandeep. I'm part of Point Source, which is a transition finance platform that we're building for FIs and investors.
So I'm Poyan, I'm venturelist for Catalyst. And Catalyst, what we're trying to do is to increase funding into the projects that reduce carbon footprint. And we do so by offering technology that simplifies identification of these projects, due diligence of projects, and ongoing monitoring of these projects once the funds have been deployed.
Thank you so much. So let's get started with understanding how exactly fintechs are helping the industry in meeting the sustainable goals. What are some of the innovative technologies and innovative ideas in the space of fintech and sustainability that you have seen and you're witnessing it?
Maybe I can start. And again, I think we can start with why Catalyst was born. So a carbon credit project, the amount of money they need is sometimes like $2 to $5 million. While the process that the banks deploy to evaluate this is project finance, which is normally hundreds of millions of dollars. And that process is very slow and inefficient right now. So what the fintech is doing is we are digitizing a lot of processes that today are being done manually. For example, matching your internal requirements with the projects that you're having, or seeing that the ESG requirements you have are met in the project proposal sent to you. Add to that the ongoing monitoring from, say, satellite imagery for a forestry project. All of that together, what it does is reduces the cost and increases the speed of decision making, thereby allowing more and more projects to be funded by financial institutes. So as you say, these are fintech kind of solutions into a traditional industry.
Yeah, I mean, if you look at, I think, like where we are in the entirety of this sustainable journey, call it net zero, call it the global goals in meeting the targets. The key thing lacking is the solution that enable them. Now, the challenges have been that a lot of the projects that have previously been funded, and you see the backlash against them now in the news, they have all been done without any sort of data on which to make those decisions on. So you saw this rush of excitement into the projects. Everyone wanted to fund them to help the world get to net zero, yet you don't see tangible results. So what I think fintech, especially where Point Source, Catalyst, I think the genesis really is we are trying to plug in that infrastructure around the data, the risk management, the monitoring of any funded project, such that it provides greater visibility to the end user. And these are large, sophisticated players who, even now we are, 20, 30 years into this, still struggling to come to terms with it, right? So that's really what the fintechs are trying to do. And for Point Source, that means we are, much like Catalyst, helping the people making those decisions on lending, on green finance, make those decisions effective with the right data at hand.
Absolutely, and I think what you alluded to a very important point. One of the key challenges in the industry is the fear of claims of greenwashing. So I know there's a lot of data enabled, there's an opportunity to provide actionable insights and so on and so forth. But how do you balance innovation with integrity and ensure that new technologies or the ventures are actually genuinely reducing emissions or helping in reducing, and not merely just moving the carbon footprint from one place to another?
I think if if you think about green finance space, it's a new space. I mean, the entire sustainability space is fairly new compared to traditional finance. And if you look at how it has evolved, it goes from no data to self-reported data, where people are kind of saying what they think, to now we're actually taking one step further and kind of going to the source of the data. Now, point source may pull data from specific sensors and data. We are using, as I mentioned, satellite imagery, potentially Web3, to kind of visualize data as it was created, at the point it was created, where it was created, and thereby creating more visibility. And I think visibility is something that fintechs are bringing, kind of visibility of the source data for the end user. And I think there is a push from the public around that, and there's also a push from the regulator around the fact that we no longer can rely only on self-reported data to ensure that the environmental impact has been done.
Yeah, I mean, I don't think you'll ever get away from in this space the claims of greenwashing. You can certainly reduce them, and we are trying. But fundamentally, transition finance deals with industries in transition, and they happen to be dirtier industries. So you got to start with, as Poyan mentioned, at source data, satellite imagery that gives you more visibility, potentially live data rather than something that looks back 6 months or 12 months. And that, at least you have something to hang your hat on, versus currently you're going to come around on an annual reporting cycle or a quarterly reporting cycle and sort of ask the person you made a loan to, have you done this? And they can say yes, and there may or may not be any verification of that. So we are moving to the next step to say there is live data, clean data potentially coming from the source that you can monitor as you make those decisions. And so you can certainly help reduce it, but the risk would sort of always remain of greenwashing. I mean, you look at Asia, right? Like 60% of power in Asia is coal, right? Dirtiest source of power, but they all also happen to be the youngest power plants around, like average 15 years, 15, 20 years, which means that if you want to now transition these plants onto cleaner sources, you gotta have some data on which to make the decision. Are the plant owners really transitioning these assets to a greener sources of energy? And that's what I think both satellite imagery and sensors that we rely on are trying to do.
Right, very interesting point. And I think, Poyan, you mentioned a very important point around there's a force or there's a push from the public as well as from the regulatory standpoint as well. So what are some of the key partnerships that exist today that binds the ecosystem together or are missing that can actually accelerate or help accelerating the impact between the various players that you see in the ecosystem?
I mean, once you go into this space, I come from a clean tech space. I'm moving into finance. And once you start looking at a new space, maybe you have fresh eyes. If you think about it, how a green finance project or a carbon credit project works. First, that you have a project developer that has an idea, brings it to a financier that invests equity type investment. And that person does the full due diligence and all that, and says, I will invest in this if you find some debt, someone who's provided debt to you. That person now goes to a bank, and this entire process starts from zero again. So the bank does not benefit from all the work has done from the previous investors. Now, the easy question is why? Why can't we actually share information between these different financiers in a way that would reduce the cost of due diligence, thereby allowing you to do smaller projects, etc. So some of it, as I mentioned, it will be regulatory. Right now, the central banks in Singapore, MAS, is tasked with making some sustainability level information available for everybody. But I think private sector themselves are also moving because, again, investors are looking at what the problem they need to solve, and they realize the way they work today is inefficient. So getting together in some kind of consortiums or along the value chain, from philanthropic financing to equity financing to off-takers to lenders, etc., on one platform to exchange information, that is just a more efficient way of working. So I think that's what we will be moving towards.
Yeah, I mean, I think Gwen captured, I think, most of it. The taxonomy is being developed that helps cutting across Asia, because currently you go Singapore, you go Malaysia, you go Indonesia, and you got to deal with different. So ASEAN taxonomies and all these taxonomies that MAS inaugurated at COP last year helps step in the right direction. But I think you still sort of have the same. You'd have a base layer, and then you still have multiple layers on top, local exchange on top. So you could definitely help simplify it. You could definitely do more cross-border stuff that is needed for funding to flow, and that is coming up. But you could argue not fast enough. But Singapore is definitely taking the lead, at least in Asia. I think HKMA is sort of also pushing for their plans, and they've just launched recently in Hong Kong as well. So it's coming together, but it will be the blended finance approach. Banks chip in, governments chip in, regulators chip in with a common taxonomy layer that someone looking in says, yeah, that makes sense. And for us implementing on our platform makes life so much simpler. Right now you're going to deal with 20, 30 odd frameworks if you're lucky. Otherwise,
If you get to know.
yeah, if you get to know them, yes, exactly.
I just want to add to the point about fast enough. Think about 2030. We have goals from 2030. 2030 is not that far away. And as we get closer to 2030, we realize that we will be behind. There will be some shift in terms of regulation, some sticks, and potentially some carrots, meaning incentives for people to move along. Now, to make change in regulation, implement them, and actually make sure that the financiers are following that, it's not easy. So that's also where a lot of technology and fintech solutions, be it RegTech to help people keep track of all these changes, be it AI-enabled solutions to kind of deploy funding more effectively, or other solutions. I believe that there will be more. Right now there are green finance professionals in this room. It's arguably not a massive, piece of the total investment for a lot of financial institutes, but that we need to believe that will grow.
Yeah. Interesting point that when we are talking about the investment size, or the size of investments to grow, and we go closer to our net zero goals. One chain of thought, or one group of thought process, is around the more it is incentivized, the more the behavior and the more the risk of greenwashing. What is your view around balancing the incentivization, green financing, green loans, and so on and so forth, and balancing again back to the point of making sure how data can help, how AI can help in reducing the risk of greenwashing, how technology can help?
Well, I mean, firstly, I think we live in a capitalist system. So we need to link environmental performance to some kind of financial outcome. Okay. So in terms of incentivizing, I am a great proponent to do so. I think we should do more. Right now, let's be frank. I mean, a green loan, the discount you're getting on the interest rate is minimal. But we need to believe that discounts will become more kind of meaningful for people to change behavior. And the way, again, and it is not driven by green washing, but a regulator looks at you and says, if you have lended to oil and gas companies, you have risk. You have transition risk. You have a risk of carbon tax increasing, and your oil and gas companies can't repay you. So therefore, you need to hold more capital. Therefore, you need to increase the interest rate for them. So I think that's what effectively will happen. It's not so much an incentive for you to give green loans, but penalizing the bad loans, and a difference between these two become more and more important. Now, the challenge, and I think why fintechs are needed, is a lot of course, I mean, the big power plants is one issue, but a lot of things that we need to change is down to, you know, smaller SMEs, down to consumers, and kind of driving that incentivization down to that level is extremely hard without technology. So that's why I believe there will be a number of fintechs in this space across the size to drive this transition.
We think about this a lot, obviously, because we're providing a point of source data platform. You can be accused of greenwashing a lot. But I reckon it's one of those risks that you have to take, right? Like, ask yourself, what choice do you have? Even now, with everything that you're throwing at this problem, you are not going to get to net zero. It's not happening. Like, it's an illusion. First numbers were, when I first started tracking this, I think it started with 500 billion, increased to 1 trillion. Then someone came along and said 2 trillion. And actually, if you now look at the latest research, it's $6 trillion over the course of the next 20 years. And if everything happens, you put in the money, you do the transition, then you have a chance of getting there, right? So it's a risk worth taking. Otherwise, you might have a few bad apples, but with the right incentives, I'm sure you can tailor it. Or if you're not even incentivizing people to do it, as I said, with the way emissions happen especially in emerging Asia, you're not gonna change. You're not gonna move the needle on reaching your net zero goals. So yeah, I mean, that's sort of, you know, our take on it. We try to minimize the risk, and it's the risk that's worth minimizing as new technologies develop, as we get more, and you sort of calibrate after each project what has happened, how we can fix it, but at least the right incentives are in place to say, yeah, the plant needs to shut down or needs to transition to cleaner fuel, and we can then move forward.
Exactly, and so is the intent.
Yeah,
I think
exactly,
we start with the right intent, and then moves to.
But for me, the frustration is everybody's talking about the risk of greenwashing. No one is kind of pricing risk of not doing it.
Yeah.
Like, we just had this massive flood in Valencia in Spain, billions in damage, lost lives. No one is pricing that stuff. So I believe that that's kind of that trade-off as we go will become more and more clear. I mean, what is the risk of actually having massive amount of farming land being unusable? What's the actual economical cost of that? Forget the human suffering, versus driving, you know, trillions of dollars into that. And I think, sadly enough, it's the money that will talk. That guys like these, in my belief, these waves of immigration that you have from Africa to Europe is driven by climate change, because people couldn't sustain themselves in Africa. What is the cost of that compared to investing in climate mitigation? So I think that will drive the changes.
Actually, that's a very interesting point. And personally, even I would think of doing a project, an investment into a project with risk of greenwashing, but actually the cost of not doing it is something that completely, it's very human to actually miss out on inaction, the cost of inaction. Now, sustainability is a global concern. It's not something that is one industry or specifically to any country. Going beyond the fintechs and financial services, we spoke about the ecosystem a little bit earlier as well. What are some of the cross-industry partnerships when we talk about other corporates or other industries? What are some of the key partnerships that exist today? Where do you see the opportunity of establishing those partnerships? And I would go deeper into that by asking that where do you see the biggest opportunity, which industry, if you were to target, whom would you want to collaborate with?
I mean, there is a short-term and a longer-term view on that. And a short-term right now, again, like EU taxonomy, I'm not sure if you guys know that. EU taxonomy says, guys, when you import something to EU, which is the world's largest market, I'm going to look at the carbon footprint of this thing. And I'm going to look at what it would have inside EU. And I'm going to charge you at $150 a ton carbon. Suddenly, a t-shirt kind of produced in Bangladesh with a coal power plant doesn't make financial sense to import to Europe. Better to do it in, in Eastern Europe on solar power. So that kind of thinking, which is again, it's a purely rational financial decision, I think will drive behavioral change, because then suddenly the guy in Bangladesh realizes, wow, I lost my biggest market, now I need to change the way my grid works, So those are some opportunities there. I think beyond that, it just generally across the industries, like the consumer-led pressure on your large Western companies ricochets into Asia. So say Apple. Apple goes and says, I want to be net zero. Apple doesn't produce anything, Then Apple goes to its chip manufacturer, Micron, and says, I want you to reduce my carbon footprint. And Micron goes to its packaging company in Philippines, and suddenly you have a company in Philippines that actually wasn't that interested in sustainability, wasn't forced by Philippines regulation, that jumps up because its bigger customer is starting to say, hey, when you sell to me, I will look at your carbon footprint and I will grade you on it, and I will not buy chips if it's bad. So I think looking at kind of the industry value chain and see how you can service them along that industry does make sense. Now, is it tracing, data, place? Is it actual carbon reduction offering packed with the financing that makes sense? Is it that you're further subsidizing this entire investment with carbon footprints? These are all kind of up for grabs right now.
I mean, our own platform's focus is on the largest, dirtiest sectors who are quite naturally incentivized, or have become, as Boyan mentioned. I think Europe being the prime geography. Potentially, if you want to do a new oil and gas project in Europe, you'd end up, outright rejected or getting a license. So we see these industries quite motivated to have sensors at their plants. We've seen shipping, large shipping companies already establish some of those processes where they feed to a large consumer. So you'd have the same, you take Coca-Cola, you take any of these guys that rely on a sort of a supply chain for their scope 3 emissions. They would all ask them, are you tracking it? So we see that incentive now filtering through to these industries who have also now come on the table to say, yes, I want that financing to be given, because I want to, currently I have it in 10 fields. In oil and gas case, I want to increase it to 100, and that requires millions of dollars of investment, and therefore you have an incentive, natural incentive for both sides to come together. So I think already happening, we're seeing a lot in both oil and gas and shipping, and real estate being in Singapore. You see the natural focus. Singapore government has already asked a lot of this data. It hasn't really filtered down to a consumer level yet. I guess I don't feel it at my consumption, but it's starting to come. So I think those are the three sort of that have really started to push towards. And hopefully others sort of jump in as incentives, right? Incentives are coming. Green mortgages, right, for your home. That like sort of, so consumer I reckon is at the far end of it. And as always with most transitions, the leading industries are where this is at.
The last one, I mean, if you think about it, I think trade finance could potentially play a role. We've seen some customers asking their suppliers to deliver a material at their factory at zero carbon. And so I want it carbon neutral here, because it just becomes too hard to measure it. And if you think about the trade finance here, he knows what is being transported from A to B and how it's being transported. So if I have all that information and I could do a carbon footprinting on what is being transported, then you could start offering offset, or offering them to, okay, if you take a lower carbon footprint road, the total carbon footprint go down, and then you can have green trade finance, etc. So there may be opportunity in that space for for the finance institute.
Right, and I hear a lot of, and both of you started early on, right at the center of the sustainability fintech. So if you look at the trend, both in terms of mindset and investment aspect, what is the trend if you compare it from the past, present, and future as well? What are some of the breakthroughs? What are some of the shifts that you're observing? And what is the pace of that shift? Is it a bell curve or is it a flat, considering a couple of years to today and to future?
I mean, what's that?
Well, on our end, so this was, if you look at the curve, or at least the way we imagine it, actually I don't know whether it's a bell curve, but it sort of, when the requirements first came in, everyone was like, hey, what the hell do we do? Like, where do you even start? And so the obvious steps was measuring and reporting. So we've seen a lot of initial investments in that space. A lot of focus of fintechs that you see, especially starting around, let me help you measure. If you have difficulty, just come to my platform, plug in a few things, and I'll tell you what is your finance to mission. And at least you have something, you have proxies to work on. That has increasingly moved to, and then it was around purchasing on abatement credits, right? Like, if I can't reduce it, I'll buy it. And so that sort of started. And soon governments realized, oh, actually this is not reducing net emissions, because you're just, offsetting it one from the other. And so the last few years, we've actually seen investment into actual platform, like ours, focused on sort of now capturing at the source financing projects, because without adaptation, without transition, the goals of net zero are becoming difficult. And we sort of see that, at least from our point of view, see that accelerating over the next few years. I mean, currently the focus is Europe is leading by far. And so you have a lot of rest of the world. ASEAN will catch up, I reckon. US is doing its own thing, as it always does, but there is also focus towards those fintech platforms. And obviously all of this then ends up potentially with some version of Web3 credits and all of that rolled into, which, not sure you need it, but yeah, I mean, that's sort of where you're at.
Yeah, I think so. I fully agree with that. So it went from kind of reporting to more financing and stuff. I think on the other side is, if you look at the kind of non-fintech solutions, so the whole mobility sector, so your EVs, your scooters and all that, charge points, and this kind of hard tech, that has been, I mean, the development in that space has been fantastic. I was in Beijing and stand by a road which is totally silent. That's very weird. But what it does is it creates opportunities for now other fintechs to come on top of that hardware institution. Be it now solutions that allow you to get paid to stabilizing the net by allowing your car to be a battery for the power producer. Be it that you are rooftop solar that has now intelligence separately, when to use that rooftop solar in your home, when to sell it to the grid, when to charge a battery and all that. So post that wave of hardware, there was another wave of software and business models that come. And I think that kind of thinking will continue with waves of actual hardware that helps you reduce.
Yeah.
And then and a lot of these hardware players are per definition not software players, allowing like creating rooms for new business models to be created on top of it.
Absolutely, and if there are not software players, then they are a long-term. You have to go in with a long-term view.
Yeah.
And any thoughts around when you are in it for a long term, for potentially deep tech or a hardware tech, how easy or how viable the investment of the funding landscape is? Is the VC world ready to fund these deep tech, hardware tech startups today?
Yeah, I think I think the way I was, as you said, people are hesitant to do that. But if you think about it, life sciences, when you are investing in some kind of medical device company, that's honestly the same timelines.
Yeah.
5, 6, 7, 8, 10 years, etc. And we have solved that. So I don't think that per se will be the issue. The issue is to scale it up to a size that makes a dent in the actual climate change. I think that's where we need everything. We need green finance, we need carbon credit, you need hardware, you need all of it together
Very
to actually make a
interesting. Yeah, very
dent.
interesting analogy.
Yeah, I mean, it's coming on, right? I think that's our point about blended finance before. That's where this sort of you gotta take few leaps of faith to say that tech is being developed. It will, as it happens, it requires a few iterations before it becomes useful and meaningful. But you see sort of that skepticism changing a bit, because you had this again initial gold rush, sort of everyone yay, change the world, crash, nothing is happening, and now they're sort of picking up slowly, believing yes, there's actually tech being developed that you can measure, you can report, you can finance, and then hardware plays being developed in parallel for the same cost. So it is sort of, I think we do see people taking a longer view, especially if it's a blended finance approach, and sort of getting investors into the fold. I think there's like a good bit of optimism on the investment side.
That sounds promising.
Yes, yes, it is.
Right. So my final question before I open it to the floor. In your opinion, in your view, in how do you actually see it? What does net zero world look like to you? What is your view or vision of net zero world?
Wow. To me, sort of when we stop talking about it, is really the sort of my barometer when this thing has been so embedded right down to the consumer level that there are devices at home that are measuring, capturing your emissions. There is no longer a question of should we or shouldn't we, and everything you hear is about taking down polluting industries, and when I say down, I mean transitioning to cleaner sources, and you sort of have this sustainable ecosystem of both hardware, software, sort of players all established, and you'll have obviously some dominant players emerge that will be the default forces in this, and I think that sort of, to me, at least from an ecosystem point of view, that's what it looks like. At a consumer level, I always bring it down to my level. Am I in where you can make a very reasonable claim on your own emissions, your personal emissions, be it your flights, your food, your home, you have that level of penetration, you're very, very close to achieving net zero, because you can literally map out and measure every single thing. We can't measure it, you can't reduce it, and so to me that's what it looks like, a very sort of small micro view of net zero.
I think similar. I think this is a world where kind of destroying environment actually costs you. So we've adequately priced in that. And I think again, once we kind of add that, it will fix itself. The problem is timelines. I think if we just go as we are, this will take for long. So you may end up in some kind of COVID level panic for us to accelerate this. But hey, I believe that this will happen, and that's why I'm kind of investing my own time in a startup that's supposed to be part of that journey.
Actually, to be honest, very well defined. I could actually visualize the world myself. And the analogy, I think my key takeaway from today is the analogy to life sciences. Because there was always a question in my mind, and as a technologist, when I'm choosing between building a deep tech versus a quick tech, would we be able to raise funds? But analogy with life sciences, I think that's phenomenal. Similarly with COVID, will it take a COVID for us to go to or something similar to COVID to go net zero? But thank you for your time, and open to the floor for the questions. Anything that you would like to ask, or anything? Go for it.
the space so that there are microclusters so that the valuation can actually be done geographical or specific industries or municipalities, because financial institutions are going to struggle with stranded assets.
Yeah.
Today, central banks are doing some stress testing. It's not granular enough, but commercial banks have a big role to play.
Well, as a financial modeling, just if I just put that my sort of CFO hat on, everything is priced in the cost of capital, and in so much as it can be. So, and I'll give you an example. If you look at traditional investments in sort of early stage, let's take a deep tech sort of startup or a med tech startup versus government bonds, any large institution, you're looking at sort of massive difference between how I'm going to discount the cash flows, how much I trust the cash flows. Now you can actually ask, well, where does that trust come from? That trust comes from reliability, dependability, sort of no shocks to your belief systems on a company, and you come up with a nice at least estimates. Now what happens in at least so far, if you look at someone giving a green loan, they are having a hard time in saying, to your point, will this asset still have an economic value by the time the credits have materialized? Because it might just end up being an obsolete asset. I've lost my value. But when they're looking at that project, at least in our discussions with some of the banks, the discount rates being used are sort of materially higher for those projects, because they want to price the risk premium on that particular asset. Now, it's pretty subjective still, and it is subjective because you can't really say in Indonesia there is this particular risk in that market that I want to add into my model versus say in Singapore or in India, but you just sort of express it at the moment in a very crude manner with the equity risk premium. And the more data, I think, on our end, we can say, if I can give you a life of a, say, oil and gas plant where I've shown you methane capture over a 10-year cycle, and I've shown you a credible reduction in it, agnostic of the geography it is in, you should be able to then price that pretty, with a high level of confidence than you would have if you're relying on sort of audits. That's how sort of we are thinking about the problem. But I agree, like there's still a lot of back-end financing from the governments. BIS on the bank side is trying to say, maybe I'll give you a risk-weighted asset discount if you finance more, so you don't have to keep 100% of the loan on your books as equity, you can maybe just keep 80%, right? And that is incentive enough for you to actually go ahead and take the step. So some of those kinks, hopefully with data, map out, but yeah, at the moment, not clear at all how you're going to price
It's
it.
an interesting, good question. I was sitting here when you were talking. Guys, I'm not a CFO, but I would kind of started saying, hey, man, if we actually start, I think the big risk is transition. I think physical risk is not that big. Transition meaning if we just increase the carbon tax, from 50 to 100 to 200 to 250 or something like that, which are the industries that would shake out first? And then maybe that's somewhere at least to start.
I thought about this a lot. Like genuine problem for us, because we truly focus on trying to get banks to finance, right? And again, Asia as an economy, you sort of have 6 to 7 million people in the coal economy, right? Material amount of number. Now, and arguably almost larger number if I take India, like the number in oil and gases and refining, it's similar, it's huge numbers. So, I'm still not convinced that a tax actually could lead to, you might price the investment correctly, but it has an impact, right? Because there's an entire economy that runs on it. You go to Indonesia, third, fourth largest city, if you shut down that coal plant, the whole economy will just collapse tomorrow. You simply cannot do that. So you got to have that incentive coming in either to say, I'll give you something on your own RW or your own risk assets, and maybe the government will foot some part of the bill. I don't think you can get away with it. That's the only way to price it, in my opinion. But yeah, I mean, could happen with developed countries, like for sure. My electricity bill reflects that penalty for not being conscious. Yeah.
And she was,
Although, if I may, what I see as a risk for developing economies is a lock into legacy technologies,
Yeah.
which are actually pushed by some of the tail of investments from developed economies. I don't want to mention it.
Go for it.
But
Understand.
I think actually what developing economies have as an opportunity is to take
Leapfrog.
this, to really leapfrog and develop a more decentralized, locally sourced type of
Yeah, you're right. I mean,
it's very bold, and not many politicians have the backing to do so, especially because there is so much lobbying. But
Yeah.
even just from a carbon tax, reducing the subsidy, Indonesia PLN gets 2 billion a year.
Yeah, yeah.
To bear the coal that comes from.
Yes.
yeah.
That would be enough.
Yeah,
Yeah.
no, I agree, and I think it's precisely because of that, right? There's so many people dependent. You're a politician, what do you after? You're after
Yeah.
I think it's similar to what you said. It's not a chance that China is world's largest EV market.
Exactly.
They did have a car market.
Absolutely. Any other? Yes.
Yeah, so my question, okay, it says path to net zero. What about adaptation finance? I mean, that's not related to net zero, so how do you measure the benefits there?
I think it's a great question, and I think it's something that people are actually struggling with. Already, green finance they're struggling to kind of define it for every sector. What is it, taxonomy and all that. Carbon financing and carbon credit is also going through that. I think the challenge with adaptation finance is, again, defining it. What is it that is adaptation finance? What does it mean? And honestly, some people even challenge it and say, adaptation to climate change is effectively allowing us to continue business as usual. Now, the truth of it is the poorest countries are the people who are being the burnt of the climate change. So there needs to be some kind of help, call it mitigation or etc., to help them, from all this flooding in Pakistan 2 years ago. Horrible flooding, massively disrupted the economy. They need help doing that. I think it's a great idea, but from this concept to actually money in the ground, I think it will take time.
Anything you want to add?
No, I mean, I think Poyan has nailed it. A bit of an oxymoron, but yeah, that's something will pop if you can define it. Again, it took so long just to get transition finance as a sort of define what do you mean by it, and I completely agree. I think what are you adapting to? That is the question.
And the other question is just on the uptake of the solution here in Asia, because we talk about just transition and all. So I know your examples you put out Europe consumers forcing change here. So in terms of uptake across the world, it won't be a very large percentage. I think we just concentrate now. So what is the proposition like now and maybe 5 years later? What is the part?
So if I understand correctly, you're saying whether the stuff that's being done in Asia moves the needle
Yeah,
for
exactly.
I mean, if left unchanged, again, sources vary. Sort of 1 in 6 tons of emission is coming from this part of the world, so quite a material sort of sum to tackle. But I think it's not just. I don't think you can look at it just from isolation. So Asia has its own unique challenges in terms of, sort of developing economies still being built and rely on cheaper, faster sources of production, while also dealing with the brunt of some of the climate impact. So there is definitely, I think, universal acceptance that something needs to be done and is being done. But you also have this HQ effect of all these large companies based in Europe. If you want to do business and cross-border enable business, then it ends up being on the both ends. So it's not just isolated to say work done in Indonesia remains in Indonesia, it actually sort of travels, the supply chain travels across. So it is, I reckon, progress but slow, and even if you look forward, unless you move the needle on, I truly believe in this part of the world, which is going to grow, has largest populations, it will certainly move the needle towards your net zero goals.
Anything you want to add?
No?
Yes, please.
Thank you for your explanation. I think you've given a lot of different examples around bonds, real assets, basically a lot of private assets, and I think a massive chunk of what is managed sustainably, with heavy quotes on sustainably, are listed equities. Do you think it's a relevant asset class to accelerate the path to net zero, and do the example, the analysis about physical risk assessment, transition risk assessment, adapting the weighted cost of capital could apply? Is it relevant, or is it like so widely different that we need a proper different conversation on it, or is it like something that could work together?
No, I think again, if you think about the financial reporting kind of journey, it took 50 years to homogenize it, to garment on it. Now, the sustainability reporting is trying to do all of that in like 5 years. You know, the good thing with listed equity is, per definition, they need to be open and transparent with their data. They're used to that. So as soon as you start actually driving some of these requirements, they actually listen and then do that, and it allows for investors in theory to price them better.
Yeah.
Now I think as you go and as understanding of what we're talking about, which is you are right now carrying some risks that are not priced. If the carbon tax in Asia was higher, just to give you an example of Singapore. Singapore introduced carbon tax in 2019 at $5 a ton. This year it's 25. By 2027 it will be 45. By 2030, 60 to 80. So it had something that didn't have any cost at all, becoming 16 times as valuable in 10 years time. This kind of, I don't think investors have actually sat down and kind of looked at it. What does it mean if we actually go down this road? But once they do that, then you start having discounts on people that have dirty industries or are in bad geographies, etc. And I think in the public markets it gets easier. I think the bigger challenge is actually private market. And you see some of it where, at least before, some public companies were selling off their dirty assets. So it's not on our books anymore. But that, I think these people are kind of catching up.
Great. Thank you so much. And that brings us to the end of the session. Thank you for your time. And thank you, everyone. You can feel free to stay behind. We are still here. And thank you for your time. Have a good evening, everyone.